Patrick, thank you so much for joining our live event. How are you doing today?
Doing well. Thanks, Donna. Thanks, Alberto.
Absolutely. So, before we really jump into all the technical stuff about all the programs Granite Bank really offers, I'd love to hear a little bit more about you, your background, and your journey to becoming the Director of Capital Markets at Granite Bank.
Well, thank you. I appreciate it. I began my career in 1995, primarily as a commercial mortgage banker, sourcing debt structure, private equity structure with accredited investors. And I've structured over $1 billion in various projects throughout my career, primarily with investors, general contractors, and folks that are active in the commercial real estate space. Um, Over the years, the evolution of self-directed IRAs came on the scene, and we learned how to access self-directed private equity through the use of using self-directed IRAs, which was pretty efficient and served a good process for us to raise capital. As recent as 3 years ago now, I joined the Granite Bank primarily as the director of capital markets. And the driver behind it was we've got an up and coming bank with 320 billion or million in assets, I'm sorry, and growing the bank to $1 billion is the goal and beyond. But they've got lending limits that sometimes don't allow them to provide a loan to their client base. And so I introduced them to our life insurance companies, the CMBS market, and agency lenders to get execution on commercial real estate that was bigger than their portfolio could handle and or that they were comfortable with, maybe in a different jurisdiction or something to that effect. The main driver was to grow relationship and to grow deposit base for the bank as it continues to grow, and to really become a professional in providing state-of-the-art, cutting-edge debt solutions and access to private equity. So it's been a great run thus far, and I'm really excited to be here today to promote both Granite Bank and Madison Trust, who I've had a great relationship with over the last, gosh, I guess 8+ years. And I'm really happy to be here today. So thanks for having me, Donna.
Absolutely, Patrick. And I have to give you a shout out. It is very amazing because you already brought up the fact about self-directed IRAs and the fact that you were able to utilize that not only to your advantage, but also for investors' advantage in helping them diversify. We're going to talk a lot more about this during this conversation, but you mentioned the term private credit. And I know before we started our live event, you and we were talking about it. I personally get a lot of inquiries from my clients and investors. Donna, how do I get into private credit? What is private credit? Why is this a buzzword right now? I'd love to hear it from the expert, that is you. Could you explain to us what is private credit and how does that differentiate from traditional bank lending?
Great question. And here's my interpretation of it. So the private credit typically shows up as a non-bank type structure, being a junior type loan and or a mezzanine type loan that has a yield and possibly a participating or carried interest. And so private credit feels a lot more intimate in the sense that it's an invitation type opportunity to get into the capital stack. And as we go through the different time cycles of a real estate, either development or the acquisition of an existing building, you have your primary lender, which is your first lender, your senior lender. You have typically sponsor equity and limited partnership equity. And the difference being private credit may show up directly behind the first lender, and it most likely is non-dilutive. So the sponsor, the ownership group, doesn't have to, in essence, share profits at the end of the disposition or the sale of the property. What they basically bargain for is a return on investment that's typically higher than the senior lender, but it's not so astronomical that the partnership or the project can't support it. So that's my snapshot of what private credit is in my world.
And is
Did
there
that make
anything? Yes, it really does, Patrick. It's you simplified it beautifully. Now, regarding traditional bank lending, and I think this is more for towards the sponsors, right? How does private credit differentiate from traditional bank lending?
okay? So a, a, a typical bank is going to underwrite the sponsor of the project, and does the deal make sense? And is the credit worthiness such that they can repay the loan? Um, Private credit in this particular instance with the Granite Bank is unique. It's a hybrid. And maybe should explain that at this moment and maybe go that direction. What do you think?
Absolutely, because I know we have a few private credit divisions within Granite Bank we really wanted to talk about. So go for it. I'd love to hear it.
Okay, so private credit really was kind of a takeoff as to whether the bank wanted to create a private banking division, which seems to be pretty in vogue for the larger banks, and serves all sorts of needs for their client base. I think what the bank has decided to do is to deviate a little bit away from the private banking and offer more innovative tools such as treasury management, which is a money market type account with insured deposits that provide a yield that's maybe a little bit higher than market. By investing in the treasury management account in a simple treasury management account, that then opens you up to participate in our Granite Bridge. The Granite Bridge was created as a private credit tool to serve as an equity alternative for income producing commercial real estate, whether it be a ground up deal or buying an existing asset. So, in its finite sense, the bridge shows up as a hybrid where the bank will do their underwriting of both the sponsor and of the project. They'll make sure that it meets and exceeds their expectations on a base underwriting. We'll then consider making an advance at 10% to maybe 15% at the high watermark of the value of the project. So a $20 million project, probably on average, you've got a 10% loan at 2 million or a $3 million loan at 15% type structure. The At that point, the bridge shows up and it falls behind the senior lender, but it falls in front of the sponsor. And the bank will close on the loan, and then they'll open up the loan to its private credit clients and let them participate in that underlying loan for up to 90% of the loan. So in the situation where it was a $2 million loan, the bank would retain no less than 10% of the loan, and they would participate off the balance. So they'd keep 2 million or 200,000, they'd participate out 1,800,000 to its private credit clients. The private credit client basically sits in the same stack as the bank. We're all participating in a participating loan instrument. The yield is paid to the bank. The bank in turn makes the distributions to the client. It's pretty seamless, and the client enjoys a nice revenue stream. The maturity typically runs from 1 year to 3 years on a max. So it's a relatively short-term investment tool, which is attractive to a lot of folks. It's a higher than normal interest rate that averages something between 9 to 10 on average in today's marketplace, and very dependable in the sense that the credit and the project has been underwritten by the bank. Now, I will say that most of our clients, and I think as we're going down the path of who is a participating user of the private credit, that user would typically be somebody that's very, very seasoned and they actually want the money in their capital stack as opposed to need the money in their capital stack. And that's a huge differentiator. So I just mentioned the participant investor, and then I mentioned the user, the borrower, in that statement. Maybe I ran over, but if you could bring me back on task, I'd be appreciative.
Absolutely, Patrick. I think I wanted to talk a little bit about the participant investor, because I'm sure some of our listeners today will be wondering, what are the qualification requirements to be an investor in one of these loans with the 90% for the private credit, right? So what
Yes.
are the qualification you, the Granite Bank, requires so that investors can participate in this loan?
So there's two things we require. Number one, you need to be invited investor, and the accredited investor standards apply. Basically, $1 million in net worth, excluding your residence, and or $200,000 in income, or $300,000 combined with your spouse. It's basically that simple. Um, and then number two, we encourage and are soon to require a relationship in the treasury management account whereby you'd make a deposit, you'd earn interest, you would be apprised of opportunities that are coming up and given the opportunity to invest in the participation loan as they come along. And we would give, excuse me, we would give precedence to those that are in the treasury management account, um, as opposed to those that were coming in from the outside. The product's relatively new, so we're building a track record. We're on our seventh project. They're all performing as planned, and it's been a very exciting and very invigorating product to be able to offer to folks.
Wonderful. I think a key sentence to highlight there is performing as planned, right? Especially in this economy, that is a huge win for you guys. So that's fantastic. Now, thank you for sharing more about the G Bridge product you guys have. And I would love to, I know the real estate participation pool is relatively new as well, but I would love if you can share some information on that program as well.
Well, thank you. I think the real estate participation pool is new. It's a work in progress. We are leaning more towards putting that product into an evergreen fund type scenario where we have pools of originated real estate loans, whether it be commercial, residential, or land loans that have been well underwritten, that don't meet, for whatever reason, the guidelines of the secondary market, Fannie or Freddie on the takeout. And so that pool we aggregate, and we are looking to have a yield that's something on average of 200 plus basis points over whatever the treasury management account is paying. So that standard savings account, um, if you could aspire to a 2 to 2.5 basis point increase over that type of a rate, that's where this type of an instrument would play. And it's steady, dependable, again, well underwritten, and we think the Evergreen Fund will probably play well for this just due to its uh, fluid nature as loans are
Mhm.
being paid off and they're being paid down and new loans are being added to it.
Absolutely. Which brings me to the initial point that you spoke about, right? Self-directed IRAs, IRA eligibility in private products such as this. So tell us, where does self-directed IRAs fit into all of these programs, especially since you've had such exposure and experience dealing with self-directed IRAs and Madison Trust?
Okay, so most recently, we've just got our first private credit offering approved by Madison Trust on the administrative side. So we've gone through the hurdles of providing the support documentation required. Madison Trust does a great job on the administrative side of getting the documents vetted, making sure that the representing sponsor is who they claim to be and what they're purporting to do. Obviously, they don't provide investment advice, but they provide a great platform as a third-party administrator. It's very powerful, especially if it's a Roth, and you guys understand the Roth versus the traditional for sure. But with an income producing project only, just with a static return, you can bargain on your static return, and if you can do it at a tax advantaged rate, whether it be standard IRA or Roth IRA, it's just really, really difficult to match that type of a return if you're in that 9 to 10% range on average. I mean, there'll be folks watching me today that may disagree, but I think the last time I checked, some of the best wealth advisors in the world on a 10-year average, they get close to a 9% return. And that's through thick and thin, up and down, maybe net of fees, maybe gross of fees, depending on their model. But there'll always be something, an outlier, where it goes through the roof or it doesn't go through the roof. I think the one thing about the IRA eligibility, given the Granite bridge specifically in the private credit offering, is if you put investment dollars to work in a self-directed IRA, the very last thing you want to have happen is a loss. You do not want a loss in that investment simply because you cannot deduct it. So, what a better tool to have than something that's got a collateral base, low leverage, strong sponsorship, and a dependable yield, and be able to put it into your self-directed IRA. Just brilliant.
I love it. And just like you said, right, Patrick, self-directed IRA custodians such as Madison Trust, we're not fiduciaries. We are passive custodians. Therefore, we don't provide any financial advice, but we do our due diligence to ensure that investors' retirement money can be invested into certain projects and it's protected per IRS regulations. And I really like the fact that you said if you want your retirement money to work for you, make money for you, then this is the type of tool you want to get into because there is a collateral, right? There is a trusted sponsorship team with years of experience, multiple deals that I've closed, and performing has planned. Again, music to my ears. I love hearing that, especially from my sponsors, because performing has planned is what we want to hear when we invest our retirement money. And just for listeners, the difference between traditional and Roth, with certain requirements, Roth IRAs 5 years and age after 59 and a half, essentially the returns can be tax-free. And that's why a lot of investors try to at least do a backdoor Roth conversion, or if they have Roth money, get into these deals using their Roth money. Now more than ever, diversifying your retirement portfolio is very important. And how do you go about, especially when investors are using their retirement money, have transparent communication and ensure that your investors, especially the retirement investors, have alignment with your projects?
Well, I think it starts with the submission of the initial underwriting and like a summary statement of who, what, and when, and how the investment is going to show up, how it's going to perform, and most importantly, how is it going to exit. We have strong underwriting standards, very transparent monthly distributions, and quarterly reporting on each asset that we place in service. So you know where you stand, you know what's coming up. There are no surprises. The other thing I would say that it's kind of unique with getting in with a group like Granite is if in fact you had an odd lot, say that you had distributions from another IRA and you had $173,000 sitting in your account and the minimums were maybe 100. We could custom tailor this to $173,000 by using the private credit tool, or use 170,000 and keep 3,000 in your account for, to pay your servicing fees or whatever you wanted to do. That's a nice option. Other than, if you've got to let 70,000 or 73,000 sit there that would just otherwise not earn anything, you can put that money to work. So that's unique as well.
Absolutely. I think that customizable flexibility, investors always love that. Pivoting a little bit from self-directed IRAs and retirement funds, I'd love to hear a little bit more about the type of deals that Granite Bank gets involved in and how do you guys actually source these deals?
Well, great question. I've been in the business a long time and I've been blessed with a great career. And I know a lot of folks that are high quality, good actors that can handle the ups and downs of the marketplace that come. So number one, it's always comes down to sponsorship. And then it comes to true relationship where it's a two-sided relationship with a give and a take. And not always taking with an expectation. But the folks that we work with are high quality folks, as I mentioned before. They don't need the money. That thins the herd. There's a lot of folks that are moving fast and they may need to fill the stack. That's typically not a client. So we've got a pretty strong filter to decide who we're going to lend to. We have had success most recently in the senior care space, primarily high acuity with memory and assisted, and some hospice and end of life type structure. And it's proven to be a very good model for the operator and for our clients. We've also had good experience with ground up multifamily, ground up senior, ground up industrial, existing asset classes such as I just mentioned. And it depends on the type of general partner. If they're a general contractor and they build things, they typically want to build things from ground up, or they'll do a renovation, but most likely ground up. And we have a network through our various sources, the bank to be one of them, our title companies, our property management network, the investment banking community, the wealth advisors, our CPA networks, our lawyers, and we've just got a very strong, robust group of folks that know when they call us, they're going to get a straight answer and they're going to have an opportunity to participate in something such as whatever it is we're promoting at that time.
I love it. And I couldn't agree with you more. I think one of the most important things is the sponsorship team behind any deal, right? And I think I somewhat answered this question for you already, but before we start seeing what the audience might have to ask you, I'd love to ask you, what separates Granite Bank from its competition?
Well, this may be cliche, but it is truly relationship. And I'm not making it up. It's all about relationship with this group. So they're a first-class group of folks, family owned and operated. They've been through the business cycles over the years, and they'll go the extra mile for those that come in and actually take an interest in having a depository relationship as well as a lending relationship, as well as cross networking. And if you take a look at how something like a Granite Bridge shows up in the capital stack, it's so efficient compared to some other I can get you done, but they don't show up type scenario. The dependability with the Granite Bridge is super high, and that's based on relationship. So if you get the opportunity to get through our underwriting sieve, the bank's going to go the extra mile to get the deal done for you. And I would just say it comes down to relationship, entrepreneurial, and trust.
Absolutely. And I think that is important for both the investor as well as the borrower. So, Patrick, thank you so much for your kind words. And the Madison Trust team thoroughly enjoys working with you as well. And we thank you for joining our live event today and sharing your expertise. And I'm pretty sure we had a lot of our audience very interested in what you had to say. So, thank you again.